In this video, I'm going to show you exactly how to buy a home with zero down during residency using a loan that was built for your situation. Here's what most residents are often thinking when they match. I've been in school for so long with little income. I don't really have any savings. My student loan balance might look kind of like a phone number, and there's no way a bank is going to give me a mortgage right now. And that does make total sense if you understand how conventional mortgages usually work, because that conventional system was not built for your career path. Here's how a normal bank is probably going to underwrite you. They'll look at your debt load, they'll look at your current income, and they calculate your debt to income ratio. For most residents, that number is going to disqualify them on paper. You're carrying $200,000 to $300,000 in student loans. You're earning $55,000 to $85,000 a year as a resident, depending on your specialty and your market. A conventional underwriter is going to run that math and say no. But here's the reframe: physicians loan programs don't underwrite you like a regular borrower. They underwrite your future, not your present. Student debt gets excluded from the debt to income qualification entirely during your residency, and your signed offer letter counts as proof of income as long as your start date is within 120 days of closing. Your contract becomes your qualification. The system was built for exactly where you are right now. Now, here's the second thing that I often hear from residents. Even if I could qualify, I've been in school. I don't have any savings for a down payment. How do I buy without strong savings sitting in an account somewhere? And that's where this loan itself really becomes the answer. Our physician loan at AMC Mortgage allows you to purchase a home with 0% down on purchases up to $1.5 million, and there's no private mortgage insurance. And that last part matters more than most people realize. Private mortgage insurance, or PMI, is a monthly fee conventional lenders require when you put less than 20% down. It protects the lender if you default, and you carry that cost every single month until you've built enough equity to remove it. On a $400,000 home with a conventional loan, PMI runs about $143 a month. On a $500,000 loan, closer to $178 a month. Over a 3-year residency, that's between $5,100 and $6,400 in extra monthly cost than a physician loan. Eliminates entirely. And here's the side-by-side. Conventional loan, $400,000 home, you need a down payment and you're carrying PMI every month for years. Physician's loan, same home, zero down, no PMI, and you're building equity from the day you close. Zero down with no PMI isn't a loophole, it's in the design. If this is landing for you, go ahead and do me a favor and hit subscribe below. I put out videos like this every week for physicians and residents who are trying to figure out the financial side of this career. All right, gonna get back into it now. Now, here we go for the trade-offs, because you deserve an honest picture. Our physician loan at AMC comes as a 5/6 arm or a 7/6 arm. Here's what that means in plain English. With a 7/6, your rate is fixed for the first 7 years and then adjusts every 6 months after that. With a 5/6, your rate is fixed for 5 years and then adjusts every 6 months after that. The caps on the 7/6 are 515, meaning your rate can't move more than 5% at the first adjustment, 1% at each adjustment at that, and no more than 5 over the life of the loan. The 5/6 caps are 215, so tighter movement at that first adjustment. For a resident in a 3 to 5 year program, the 7/6 means your rate doesn't move a single time while you're in training. And on the rate itself, our physician loan rates are on par with conventional rates for similarly qualifying borrowers. You're not paying a premium for this loan. One more thing worth knowing: this loan is available for a primary residence or a second home. The one thing it's not used for is investment properties. Those are real parameters. Now you can understand them and make the decision with the full amount of information. Now here's a story. She came to me while she was finishing med school. She had a signed offer letter from a residency program with a start date inside that 120-day window. She hadn't started yet. She had student loan debt. She had no savings for a down payment. On paper, every conventional lender in the country would have had to turn her away. We used the physician's loan. The offer letter was her income documentation. The student loan debt was excluded from her DTI calculation. She qualified. We found her a home, and we closed before her graduation ceremony. While her classmates were at graduation parties talking about apartment hunting and lease start dates, she was already a homeowner. If you have a signed offer letter or a residency contract with a start date within 120 days, you likely have everything you need to start the qualification conversation today. Now let me bring all of this home for you in 3 beats. 1, the conventional mortgage system was not built for your career path. The math works against you on purpose because conventional underwriting doesn't care that you're going to earn 3 or 4 times your residency salary in 5 years. Second, the physician's loan at AMC was built for exactly this: zero down up to $1.5 million, no PMI, student debt excluded from qualifying. Our offer letter accepted as income as long as your start date's within 120 days of closing. Rates on par with conventional. Available for primary or second home, The product exists and you're eligible for it. And third, remember that client I told you about at the top of the video? While her classmates were celebrating graduation, she was already a homeowner. It's not luck. That's knowing the right product exists and having somebody in your corner who knows how to use it. And here's the question to the answer you're probably still sitting with we haven't addressed. With your residency income being lower than what you'll earn when you're fully practicing, why would you buy now instead of waiting until then? Because you're going to pay housing costs either way. The question is whether that money goes to a landlord or to equity in a home that you own. 3 years of rent at $1,500 to $2,500 a month is $54,000 to $90,000 out the door with nothing to show for it. A physician's loan changes that equation from day one. If you're a resident or you're about to start residency and you want to know whether you'd qualify for a physician loan, follow me over on Instagram. The link's in the description. Send me a DM with the word resident and I'll send you back a list of exactly what documents you need to start the process. And if this video helped you, subscribe. I cover this stuff every week specifically for physicians and residents who are figuring out the financial side of this career. I will see you in the next one.